So we know consumers make up over 2/3 of the economy, and one of the things I love paying attention to is what's happening at the edges and the fringes. What's happening with poorer spending and what's happening with richer spending, because it gives us an idea of where people are starting to cut back. And there are two areas we're starting to see cutbacks where ordinarily you don't want to see them to keep a good bull market going. And in this case, we're going to look specifically at corporations and richer household spending. So let's jump in with corporations, then richer household spending, and then we're going to talk about a CEO that lashes out about what's going on in the market right now. Now, this is also related to the spending sectors I'm talking about, but I haven't seen a CEO, in my opinion, in an earnings call, a professional earnings call, lash out the way this one does. Usually CEOs are really respectful and they don't trash their competitors. All bets were off this time around, and you're going to see a little bit of entertainment in an earnings call, which is usually the opposite of what you would expect to get in an earnings call. But first, let's understand what Barron's thinks is happening in terms of corporate spending. Take a look at this. Here's a piece on companies see a slowdown ahead, and this figure tells the story. So let's take a look at the story that Barron's is suggesting. So first, companies are tapping the brakes on capital spending as they anticipate cooling demand. That's not great. They are conserving cash as they prepare for a tougher economic environment that might be prudent on their part. And good news for shareholders. After all, good news for shareholders, when a corporation cuts back, you temporarily see a boost to operating profits, right? But what if they're cutting the potential investments in their business that actually let them continue to see growth? This is actually a very important thing to consider when you're investing in stocks is, wait a minute, it's fantastic that the company I'm investing in is cutting their SG&A expenses, their selling, general, and administrative expenses. But if they're cutting selling, are we potentially robbing from the future growth of the company to have a higher margin now during potentially a weaker time? And often the answer is yes. Now, in many cases, there are also companies that just take advantage of the layoff cycle of a recessionary environment to get rid of poor performers. This is very normal as well. After all, think about it. Companies don't want the reputation of firing poor performers because if people regularly get fired, it makes it harder for a company to promise job security to new employees when they come. However, if a company can throw up their hands and say, whoa, recession, sorry, man, we gotta cut back. We can't even offer the food we used to offer anymore. Sorry, we gotta lay off a bunch of people. Generally, not always, okay, not always, but often the first people to get laid off are the poor performers that if a company had a firing policy would probably be fired anyway. There are a lot of companies where people would actually be really hard workers in, and they'd look around and go, this is so frustrating. There are other people putting in 10% the effort I do, yet they get paid the same amount. But the companies don't have a policy where they can actually fire people. So they wait for a recessionary cycle, and then they go through the weeding cycle. It's not saying everybody who's laid off is affected by that. Just saying. It's a very common thing that corporations do. So, in this same weeding cycle, what is Barron's telling us? Well, they're actually saying that companies may be cutting back on CapEx substantially based on the charts Barron's is looking at. And that could be a red flag for companies that sell heavy equipment or technologies and systems used in CapEx. Now, the first thing that I think of when I think of heavy equipment is I think of the investments that farmers were making during the inflationary cycle after the pandemic, during the supply chain crises, for shipping, but also for food, like farmers for even wheat after Russia invaded Ukraine, or other food products that exploded after the pandemic, such as even chicken. And so heavy equipment that goes into farming or industrial manufacturing or even the processing of meats, I think a lot of that heavy equipment was purchased and invested in during the pandemic or commodities bull run cycles. And that may get reined in now. So I'm looking Caterpillar, John Deere as potential red flags here. But I also scratch my head and wonder, well, what about ASML? Are they going to produce less chip manufacturing equipment? Well, Barron's actually gives us a little bit of insight into this. And stay tuned because we still have to talk about that crazy earnings call from a corporate CEO. And it's a corporate CEO you're all well aware of as well. So, analysts expect aggregate capex for companies on the S&P 1500 index to rise about 7%, just over $1 trillion this year, according to Citigroup. That's down from a 21% increase in 2022. That's about a one-third as much growth. And it really kind of matches inflation. It is expected to rise just 2% in 2024. Now, this I think is interesting. One of the biggest things that I personally have learned during this cycle is that things take a lot longer than normal to adjust. It takes a lot longer than you'd expect for the market to bottom and for things like inflation to actually go away. That patience is frustrating, but it's also good for planning because if we're at the beginning of 2022 and we're thinking, all right, recession's coming within the next 6 months, but it actually potentially takes 2 years, it would be good to plan for that potential heads up. Now, weakness is expected in more economically sensitive sectors, or those that see sales rise and fall with demand, economic demand. The consumer discretionary sector, which includes retail, restaurants, and hotels, is likely to see capex drop by 3% this year. Now that's interesting because retail, restaurants, hotels, and the like, which would include airlines, would make you wonder, wait a minute, is it possible that that booming segment where jobs and wages are growing so strongly in retail, restaurants, airlines, hotels, hospitality, is it possible that those companies are going to rein back their expenditures on coffee machines, new stoves, new equipment for their airplanes, whatever, as they try to maintain profit margins and as they start seeing competition at the top where they can't raise prices anymore? And the answer to this is likely yes. Consider, for example, what Darden, the company that runs Olive Garden, for example, is doing. They're talking almost solely about efficiency and productivity and doing more with less. Back a year ago, all they were doing was bragging about how they could raise prices. This conversation and narrative has completely turned on its head. Now, all of a sudden, the companies are realizing they're in a situation where they're looking at the scoreboard and they're going, uh-oh,
lost the lead.
That's not good. They don't want to lose the lead. They want to stay ahead, but they don't have PB anymore. They don't have pricing power. So what do? They stop investing in their business and new equipment to try to maintain margins to appease their shareholders. Excuse me. That is really borrowing from the future and giving to today. Because if you don't continue to reinvest in your business, your sales will probably suffer in the future. It's one of the reasons I'm personally bearish on retail and hospitality and travel. I understand there's a boom in that now, but I'm bearish on it because I don't think it'll last. In fact, before we continue with this Barron's piece, I could tell you that there are already red flags that some of these sectors are starting to get hit. Look at this. Here is a piece from Bloomberg talking about hotel rooms over $500 a night are too much even for rich travelers. And they talk about here, this may be a reflection of diminishing consumer confidence that inflated prices have not been accompanied by a proportionate increase in service quality. See, this actually directly relates to the Barron's piece and the argument that I'm making, where companies are starting to cut back to maintain whatever margins they have. They can't raise prices any more than they already have, but then people are going, what the hell? I'm paying a premium and y'all aren't even keeping up with expenditures and investments into your own business. The service is actually getting worse in certain cases, despite you paying a premium for certain products. The results come during what should be one of the busiest periods for travel booking. March is when people start finalizing summer plans and early birds get a jump on year-end holiday reservations. Okay. However, some 69% of poll participants said their maximum budget per hotel room was $500, while 24% were willing to spend $1,000. Still, 5% set their limit at $2,000 and 2% were willing to spend $3,000. Respondents include traders, portfolio managers, senior managers, and retail investors. Although $500 to $1,000 might seem high, the range eliminates the fanciest hotels in major markets. Okay, so they kind of give a little bit of a breakdown here of this survey. And here is where they suggest a difference. I'm always interested in the delta, the difference of what's going on. The results of the survey suggest that luxury hotels, restaurants, and airlines will face increasingly irritated customers or consumers this summer. I don't even want to talk about how disgusting some hotels have gotten in that COVID's over. And they're still saying, yep, sorry, no room service, COVID. And I'm like, this is bullshit, It's crazy. Anyway, bank failures, fast inflation, elevated mortgage payments, and the softening labor market, especially in the high-income sectors such as tech, could see tourists keep discretionary spending in check. This is a shift. We wrote a little note here. This is a shift from what we heard from American Express, where individuals were still spending through the recession. That was in the American Express last quarter earnings call. And American Express appeals heavily to white-collar and higher-income individuals. So what's important about this? Well, what's important is we're starting to see complaints at the margin, at sort of the right side, the right tail, maybe the higher-income tail, where people are starting to go, okay, starting to run out of money here and starting to have to pull back. In my opinion, that's negative, not just for the companies that would be investing in CapEx, like we were talking about, the hotels or airline manufacturers, but it's also a red flag that not only are we going to start seeing some of that softening at the lower consumer end, where we're probably going to see most of the softening and most of the hit, but we're starting at the margin to see some hit to that discretionary higher income phase. And that's something to pay attention to as well. This is why I always encourage people, make sure you have some kind of side hustle where you're making additional income. In fact, if you want to make YouTube videos, the easiest way, in my opinion, to do that is check out StreamYard. StreamYard is awesome. It's a fantastic platform. It's a sponsor for this segment. And they're a great platform where even if you're not live recording, you could use a web browser to record yourself. Just go to metkevin.com/StreamYard to learn more. You could use a web browser to record yourself and actually pop up different windows or different banners. For example, I'm still working on editing some of my own banners that we threw into Photoshop, but I could throw up a bunch of different banners here. Like here's one I throw around myself, metkevin.com/free. I could throw up the little paid promotion thing. If I want, I could even throw up a little ticker at the bottom over here. It's a pretty cool platform. So go to metkevin.com/StreamYard and realize you could record your presentations, download them in HD, edit them even within the browser. Don't even need editing software anymore. They do it with you. So check out metkevin.com/StreamYard. It's been a lifesaver for me for the past few years, especially since I'm traveling so much. But going back to this and wanting to get into what this CEO is saying as well, I do think it's worth wrapping up on this piece right here before we transition, where there's this mention here in Bloomberg that retail investors see positive airline share drivers, but institutional and professional investors actually think the airlines are going to get hit pretty hard based on a lack of potential CapEx spending that we're starting to see at some of the airlines. Going back over here to Barron's, look at this. The reason companies are watching their big ticket spending is because they're preparing for more muted demand and profits. There used to be this story that my father-in-law used to tell me. He goes, "Hey Kevin, there's this story about this father who ran an antique shop off the highway, and the antique shop was doing very, very well. It was like 2021, right? The antique shop is killing it. It's got growth. Its income is going up. Everything's fantastic. It's spending money on advertising. It's growing. It's going great." And then the son, who's college educated, says, "Well, Dad, don't you realize we're going into a recession? You should cut back." And so the father-in-law says, "Oh no," or the father said, "We're going into a recession. That's terrible. Well, we better cut our spending. Let's cut our spending on that billboard that we have at the corner of the freeway that says exit here to our antique store. Let's not spend $1,000 a month anymore on that billboard because we need to prepare for the recession." And so they cancel the billboard. Sure enough, people don't come to the antique store anymore because now the billboard is gone. And all of a sudden, income falls for the store. The father's like, "My gosh, son, you were right. We're going into a recession." And the point of the story is to argue that good Lord, some of the recessionary impact of the economy that we're in can very much be self-fulfilling. When businesses cut their CapEx spending, they can induce their own recession. Now, this is exactly why. And I try to be really neutral here. I'm just going to put my cards on the table and go, the reason I selected the cards that I did is because I think the cards that I chose, the stocks that I chose, are basically businesses that not only have pricing power, but are going to continue to invest in CapEx and growing their businesses during the recession, whereas other businesses are cutting. So I think consumer staples, restaurant, retail, hospitality, all of those, and even the industrials like the Johnson & Johnsons, the 3Ms, I think they're all looking at cut. All of them. Because they're self-inducing basically their own recession. Whereas I think the companies that are not are first of all the ones getting the stimmy checks, but second of all the ones that are basically the growth companies of the next decade. The energies, the chips, certain electric vehicle manufacturers, right? Those are the ones I think have pricing power because first of all, they're getting massive stimmy checks from the government. That really helps you continue to spend. And if you continue to spend, you continue to grow and you don't self-induce your recession. Think about it for a moment. If you're that antique store, except instead of selling antiques, you sell solar inverters. And the government's like, hey, don't cut back on spending. Here's billions of dollars. Here's a fire hose of stimmy checks. Please keep investing in your business and spending. Those businesses are gonna be like, all right. Like, I hate to call it like stupid proof because obviously I can't guarantee it. But I'm just saying, if I could shake people and go, come on, it's obvious. Go where the stimmy checks are going. Anyway, so let's keep going with this Barron's piece here, and then we got to get to that corporate lash out. The reason companies are watching big ticket spending is because they're preparing for muted demand and profits. The Federal Reserve's interest rate hike started last year, but usually reduced demand and inflation with a delay, so companies have only begun responding as they reduce large investments once they see the beginnings of destruction to demand and sales. In fact, Citi data shows that in the past few months, banks have tightened their belts on lending as a result of consumer and business credit worsening, which should curb demand. Now, I'm actually surprised that we've actually started seeing some tightening on this because the banking crisis, according to NatWest and many banks, hasn't really started yet. But then again, they're talking about the past few months. So it is true that we have seen if the line is down, like if I invert this, usually tightening credit standards is an up line. But if you invert it, it just psychologically makes a little bit more sense, like less availability of credit. The credit tightening has kind of been doing this anyway. I think there's this anticipation that the bank crisis would lead to more of a drop-off, but that hasn't happened yet. But yes, overall, larger banks have been tightening over the last year. Okay, so this reinforces stagnating earnings growth concerns. Stagnation is oftentimes what leads the stock market to turn red. The good news, though, is according to Barron's, the stock market has already reflected much of the economic challenges, and the S&P 1500, while above its low of the bear market, is still down 14% from late 2021's record high. The other good piece of news for stock investors is that lower CapEx means companies have more flexibility as to what they can do with their cash. They can return more cash to shareholders through dividends and buybacks. This, by the way, I think is a mistake. I really think it's a mistake for corporations to give more dividends right now. They should be investing more in their businesses, but that's okay. I still invest in some businesses that do buybacks as well. Look at Enphase, for example, which amplify shareholder returns. The S&P 1500 free cash flow is expected to gain 9% this year because of reduced CapEx. That's fine, but what's that going to do to return to earnings next year? The point is that investors should expect weak demand going forward, but that doesn't mean completely shy away from the stock market. Fine, but what do we want to keep in mind going forward, and where's this CEO lash out? Well, the first thing that I would keep in mind is, I alluded to it earlier, and I want to just give you my opinion on it. I was initially thinking, okay, Caterpillar, John Deere, but what about ASML? I think because of the CHIPS Act and the massive amount of factories that are going to be built in the next few years, and the fact that there's like a 2-year wait to get a lot of this industrial equipment, I think companies like ASML are actually going to be just fine, thanks to this massive inflationary stimulus checks that are coming to not only electric vehicles, solar, and such, but chips specifically. So Now, we have to get to, we already covered our sponsor for the segment, metkevin.com/StreamYard. Please check them out. It really helps out the channel if you go to metkevin.com/StreamYard. Check them out. They're fantastic. Try them. You get a free trial if you sign up anyway. But we now have to look at this earnings call where I have to say, I feel like this guy is totally depressed. I initially talked about this earnings call in a course member live stream, and we only briefly looked at it because we had multiple other analyses to do. I really enjoy doing the fundamental analysis with all the course members. But this one I went into a little bit more detail, and I just want to read you some of the segments here. I'm going to read you some of the segments here of this business because I want you to see the sentiment change. Remember what happened when we went into this crisis in 2022. Everybody's talking about how they can raise prices and how great everything is, right? Well, now what I want you to see is the sentiment of the CEO of none other than Restoration Hardware. Yes, Restoration Hardware. So, Steven Forbes, an analyst, asked the CEO, can you talk about an inflection point within the business? And here are some of his responses. Sure, I think based on the times we're in and uncertainty we're facing, whether it's the continued rise of interest rates or the next bank or two that get hit, it's hard to be anything but conservative right now. I think it would be foolish to be not just from the perspective of disappointing investors, but disappointing ourselves and possibly making decisions and investments before we could see around the next corner. You hear this? Rein in. Don't spend more on CapEx. Rein in. Get small. Get scared is what he's saying, because we haven't seen around the corner yet. Because instead, he talks about it's a very unsettling feeling. It's like the days of Bear Stearns and Lehman Brothers, and we're just waiting for the next shoe to drop. It's very unknown right now. So we believe that there will be an inflection point in the second half. Notice he doesn't say good. We don't know what it is. What will the economic environment be in the second half? What would be the condition of the banking industry in the second half? Where will interest rates be? What if inflation is persistent? All one has to do is Google the history of the Fed's funds rate and zoom into the 70s and 80s and look how many times the Federal Reserve brought inflation under control. Yes, Mr. CEO, let's completely ignore that in the 70s we left the gold standard and we let inflation expectations unanchor, and the Fed had a start-stop mentality that led to a lack of confidence for the Federal Reserve. Let's completely ignore those things. And let's just talk about the fear of the 70s and 80s, how basically we have to not spend money anymore because we don't know what's around the corner. This is literally a CEO that wakes up and probably loses sleep at night and then wakes up in the morning trembling that this company is going to poopsie doopsie. This is Restoration Hardware, by the way. And I mean, if you just look at their earnings, right here, you can see their margins are starting to get hit. Now, over here on the right side, you've got their past margins and their income from operations at 14.5%, way down from the over 20% we used to see. Their net income is down about an average of about 3 percentage points over here compared to the past reporting quarters. So you can tell there's a numbers reason why as well. But let's keep going with what he's saying because he starts getting a little angrier. There's not, oh my God. Hello, grammar. There are not many people. Do you know they should really have a word there, right? Like it should be there, like that. That should be a word. It should be pronounced there. There are not many people on the planet. See, that would be good grammar, a shortening of there are, but that's how it should be written. But that doesn't exist. Instead, people get lazy and then they just say theirs because there's no contraction for there are. That's kind of weird, isn't it? Anyway. In this context. Okay, so continuing. I don't know why we go on these grammar tangents. There are not many people on the planet in levels of authority and responsibility that were old enough to experience those times. And I think having a conservative view and being prepared, having a strong balance sheet and trying to see the whole board and all of the moves is basically prudent. Okay, that's fine. So he's making the argument that we're so scared at Restoration Hardware, we're gonna basically compare this to the 70s and 80s and try to buckle up as much as possible, which is not a bad idea. It is not a bad idea to say, hey, let's pause and let's make sure we could rein in to make sure we're not running away and spending all of our money and not being conservative to where then we have to get emergency debt, right? That would be very bad. I'm sorry if you're sending me promotional emails every day if not every day, multiple times a day, calling them different things. You want to call your promotion something different? That's interesting. He's starting his little lash out right now. We're not pushing the panic buttons on promotion. I wouldn't call it panic kind of promotions. It's really trying to hang on to the illusion of where the business was in the pandemic, right? So in other words, he's starting to allude to how they are different from other businesses. They're saying, we're not going to do promotions because we're Restoration Hardware and we're fancy and better than promotions. And then he's starting to compare to other businesses that are sending promotional emails every day, sometimes multiple times a day. He can smell the fear at other companies because they're freaking out and they got to get more sales. Well, take a look at this. I have never, ever seen a CEO pull this one. So listen to this. And that's even in this environment, and the product that's on its way is by far the best work we've done. Talking up their business, okay, great. How they have a value proposition and they don't have to send all these disruptive promotions to people that are below us. Wait, what? And I think that will be disruptive, not only to the high end, it's going to be disruptive to the people that are below us in the market, just because we have the scale to buy in-stock inventory and many people don't. In other words, you really have a CEO who's literally like, we don't spam people with promotions. We aren't going to suffer like the people who are below us because we're the high-end corporation. And then listen to this. Literally goes on to name a company by name and bag on them. You ready for this? Here we go. The platforms that are out there today, whether it's a Wayfair or others, again, I understand they don't take the position we have on inventory, so they can't really buy in volume because they're the paupers, they're the poor normies. So, continuing with the quote here, so because they can't buy in volume, they can't drive efficiency. So a lot of people say, well, aren't you worried about platform? So I think platforms ought to be worried about us, like those website platforms. They should be worried about Restoration Hardware. There is not a platform that made $1 yet or anything. I mean, Wayfair made money during the peak of the pandemic, for God's sake. No. And look, may Wayfair be able to hike their prices and make it? I don't know. All I know is we've got a really great model. We've got, I think, the most compelling vision in the industry. The guy is literally dumping on Wayfair, saying they only made money during the pandemic. And basically, Restoration Hardware is so much better because they have scale and they have a reputation and they have a brand. But at the same time, we're worried about the 1970s recession, and we're worried that, listen to this, I think it's more uncertain today than 2008 and 2009. If you didn't have the inflation problem that we had today and you didn't have the political unrest, maybe it would be interesting, but you do. And so if there isn't a complete crash, which a complete crash would look like the 70s or 80s, which would ultimately mean it would take over a decade to recover from the recession, then maybe we could pray for not a complete crash. But this is what we want to prepare for. So, I kid you not, Restoration's Hardware CEO is losing his SH9T. He is literally losing it. Lashing out at the competition, lashing out at promotional emails, and lashing out that basically we're walking into the 70s and 80s. And as a result, they're going to pull back on spending. That's crazy. So look at this. In a typical environment in a slowing market, there's usually one thing to hit us at once. But multiple things are hitting us at once now. Look at this. Listen to this. Yeah, I think you've got about a 20% margin floor, not in the worst housing market though. Right now we're in the worst luxury housing market I've ever seen. One of the worst housing markets anybody has ever seen. I think in the third quarter, luxury housing, fourth quarter luxury. If you think about where luxury housing has been, it was down 18% in the first quarter, down 28% in the second quarter, down 38% in the third quarter, and now reportedly down 45% in the fourth quarter, which means because you're talking about months, they're kind of going down, it probably means the last month of the fourth quarter was down close to 50%. Then you've got the refinance market, which nobody's refinancing, so nobody's able to buy new furniture, and that means the market's really down like 80 or 90%, or 70 or 80%. Oh man, this is by far the most comical but also kind of scary earnings call I have ever seen. This is the CEO of Restoration Hardware. But then listen to this. We're cutting through the noise. That's what we're doing. We're not panicked. We're not nervous. The biggest joke ever. And then he even goes on to say this. Do I wish yelling, we'll just tell everybody we're gonna backstop everybody's savings and dance? In other words, do I wish we could just go back to the stimulus days? Of course! But I think instead we might be facing more of the 1970s. This is by far I don't know whether to be scared or to think the guy has just lost it. But you're definitely seeing a CEO here that's a lot more nervous than I've really seen anywhere. And I have to say, first of all, anybody buying Restoration Hardware stuff in this market probably needs to look at themselves in the mirror and go, why am I not buying stocks right now? And instead spending, like, why am I spending money on this expensive furniture anyway? So first things first, you shouldn't be buying crap at Restoration Hardware in this market. Save that for a bull run when you trim some of your highly profitable stocks and then go splurge on stupid furniture. In a bear market is not the time to go shopping at Restoration Hardware. First of all, my advice. Second of all, I think the CEO is seeing a disproportionate impact because I think people are smart and realize the worst thing to do is spend money like this at Restoration Hardware. And so he's seeing the writing on the wall that this company is going poopy doopsies. And it's probably going to be a while before it recovers. Part of me, after that fear, is almost tempted to short the stock. Now, in fairness, the stock has already come down substantially. And maybe that's why he's freaking out. Let's go over here to Webull, which is the platform that I like using, whether it's for trading or looking at the charts. If you go to Webull and you look at the pandemic low of 2020, we're at 73 bucks. We're way up from that, right? We're 3x from that. But look at what we're down from, 744, and we hit a low of what, 208 roughly? So we're sitting in the bottom section here of the Fibonacci, and frankly, this company might actually break lower. It's had a very rapid decline already, so I don't know how much is left to squeeze out of this lemon in terms of a short. But if you're looking for a CEO that's panicking, I'll tell you, I don't think there's any company that is more fearful right now than Restoration Hardware. And unfortunately, it's kind of a slap in the face to what American Express was bragging about. And maybe it's a leading indicator that American Express is next. Which some businesses, by the way, have you ever heard of this? They call American Express American Surpress. Yeah, anyway. I think that's when small businesses kind of get frustrated at the fees they get charged. But anyway, so American Express talks about people spending through the recession. Well, if people are using American Express at Restoration Hardware, then you might have a reason to say maybe American Express might be next. So American Express is AXP stock, and you can see they might have a little bit more on the fib retracements to go down. So if I adjust the fibbies over here, let's do a quick adjustment. Keep in mind, we talk about fundamental analysis every single day in the courses on Building Your Wealth link down below, whether it's for stocks or real estate or entrepreneurship. Check those out. I think you'll enjoy them. We even have buy now, pay later available. So take a look at this. For American Express, we've definitely come off some of the highs following the banking crisis over here. This is the week chart as well, by the way. So we've been teetering around this 162 level. It is possible, in my opinion, that American Express could go right back to these about 145 levels. If not even, I actually don't think we're going to test the 129, but 145 would be reasonable. So if I was looking for a short, I'd probably be more likely to hit American Express as opposed to Restoration Hardware if I thought at the margin we were going to see reduced spending by rich people, because really that's what matters. It's that discretionary credit card style spend at the margin. I think businesses or like chip companies or otherwise, they're still going to spend money on chips. But I don't know if they're using American Express or Restoration Hardware as much anymore. So, in my opinion, you're starting to see the cracks, not just on the lower end, but now you're finally starting to see the upper end cracks. And I'll tell you, look, I'm a licensed financial advisor. Every single day, I try to read earnings calls. This isn't personal financial advice, but I try to read an earnings call a day, and I have never seen a CEO lash out like this. I have seen pessimism and uncertainty, but this, wild. I have not seen this before. So anyway, with that said, make sure to check out metkevin.com/StreamYard. Make sure you get yourself 12 free stocks by going to metkevin.com/Webull, paid promotions. Make sure you get yourself life insurance in as little as 5 minutes by going to metkevin.com/life. And obviously, check out the programs on building your wealth, wherein you can now get in with buy now, pay later and get lifetime access. So, if you found this useful, also consider sharing the video. Thanks so much.